Most investors believe price moves because new information arrives. That is partially true. But information does not move price directly. Orders do. And orders are governed by microstructure. Microstructure is the study of how prices form at the transaction level, how liquidity is supplied, demanded, withdrawn, and priced. If macro explains why markets move over months and years, microstructure explains how they move minute by minute. And if you don't understand the how, you will constantly misinterpret the why. 1. Price formation is mechanical before it is informational. A fundamental misunderstanding, and price does not move because something becomes more valuable. Price moves because aggressive orders consume liquidity faster than it is replenished. At any moment, there is an order book. Limit orders, passive liquidity. Market orders, aggressive liquidity. Limit orders provide stability. Market orders demand immediacy. When aggressive buyers repeatedly lift offers, they clear the best ask. Then the next best ask, then the next. Price rises, not because value increased, because supply at current levels was insufficient. This is mechanical imbalance. 2. The order book is not reality. It is conditional. Displayed liquidity is optional. High-frequency market makers can cancel in milliseconds. During stress, displayed depth collapses. This is why calm markets leads to tight spreads, deep books. Crisis markets to wide spreads, thin books. Liquidity is a function of volatility expectations. Market makers widen spreads when adverse selection risk increases. Adverse selection equals fear that the counterparty knows something you don't. When volatility rises, the probability that incoming flow is informed rises. So liquidity providers protect themselves, spreads widen, depth shrinks, impact increases. Volatility is partly a liquidity withdrawal event. 3. Kyle's lambda and price impact. In microstructure theory, Kyle, 1985, price impact is proportional to order size relative to market depth. The formula simplifies to price change approximately lambda times order flow, where lambda measures market depth and liquidity sensitivity. In deep markets, lambda is small. In fragile markets, lambda increases. This means the same order moves price more when liquidity is thin. This explains why markets become unstable during stress. It's not that participants become irrational, it's that liquidity conditions change. 4. Inventory risk and dealer dynamics. Market makers do not hold infinite inventory. They manage exposure. If they accumulate too much inventory on one side, they adjust price to rebalance. Example: if dealers buy too much inventory from aggressive sellers, they lower bids to discourage further selling and attract buyers. Inventory management moves price even without new information. This is a critical but invisible force. 5. Informed versus uninformed order flow. Gloston-Milgrom models show that market makers widen spreads when facing informed traders. If flow appears informed, liquidity retreats. If flow appears liquidity-driven, index rebalancing, ETF flows, spreads remain tight. But how do market makers infer information? Through flow patterns. Persistent directional flow suggests informed trading. Random small flow suggests noise. This inference process shapes price impact. 6. Passive investing and structural flow. Modern markets are heavily influenced by passive flows. When investors buy index funds, capital flows mechanically into index constituents proportional to weight. This is not valuation-based, it is rule-based allocation. This creates structural demand. During inflows, large caps receive disproportionate buying pressure. During outflows, the reverse. Passive flow amplifies momentum and concentration. Microstructure explains why megacaps dominate indices. Flow creates structure. Structure creates trend. Trend reinforces flow. Feedback loop. 7. Options. Market gamma and dealer hedging. Modern microstructure cannot be understood without derivatives. Options create hedging flows. Dealers who sell options hedge dynamically. If dealers are short gamma, when price rises, then they must buy. When price falls, then they must sell. This amplifies volatility. If dealers are long gamma, they dampen volatility. The options market influences spot price through hedging mechanics. Many sharp intraday reversals are gamma-driven, not fundamental, not emotional, mechanical. 8. Stop clusters and liquidity hunting. Stops create predictable liquidity pools. Large players need liquidity to execute size. If liquidity clusters below obvious support, pushing price slightly lower can trigger stops. Triggered stops become market sell orders. Those orders provide liquidity to larger buyers. This phenomenon is often misunderstood as manipulation. It is more accurately liquidity engineering. Large players cannot enter size in thin markets without triggering price impact. They require stop liquidity. 9. Microstructure and volatility. Clustering. Volatility clustering, Mandelbrot, is partly structural. When volatility rises, risk models force deleveraging. Volatility targeting funds reduce exposure. Margin requirements increase. Liquidity providers widen spreads. These mechanisms amplify movement. Volatility feeds on itself. This is why volatility regimes persist, not purely psychology. Structure. 10. Execution, algorithms, and hidden flow. Institutional investors do not place large market orders openly. They use algorithms, VWAP, TWAP, implementation shortfall. These break large orders into smaller pieces. This creates persistent directional pressure over hours or days. Retail investors see slow trends. They assume narrative. Often it's execution flow. 11. Flash crashes and liquidity gaps. The 2010 flash crash showed what happens when liquidity providers withdraw simultaneously. Without bids, price cascades. Markets rely on continuous liquidity provision. If liquidity providers retreat, the system gaps violently. Microstructure fragility becomes visible. 12. The illusion of news-driven markets. News explains price after the fact, but often price moves first because positioning and liquidity create vulnerability, then narrative attaches to movement. This is ex post rationalization. Microstructure often precedes narrative. 13. What this means for you. If you are long-term, short-term price spikes may reflect flow, not value. Do not overreact to liquidity-driven moves. If you are short-term, respect liquidity conditions. Avoid trading into thin books. Understand gamma positioning, size relative to depth. Never assume displayed liquidity is permanent. 14. The deep structural insight. Markets operate on 3 layers: macrostructure, liquidity cycles, regime shifts; strategic layer, game theory, positioning; micro layer, order flow, execution; inventory, hedging. Price is the surface. Flow is the mechanism. Liquidity is the constraint. Structure is the driver. Understanding microstructure does not make you omniscient, but ignoring it guarantees misinterpretation. Final 3 takeaways. First, price moves because of order flow imbalance, not because of narrative. Second, liquidity is conditional and disappears when risk rises. Third, volatility often reflects structural hedging and liquidity dynamics, not fundamental change. Markets are not just valuation machines, they are execution machines, and execution mechanics shape reality more than most investors realize.